everyone. Here's what most people don't understand about these scary financial predictions that keep changing every few months. While regular folks panic and sell their investments, the smartest money managers quietly do the exact opposite of what they tell everyone else to do. I'm talking about predictions so unreliable that the same experts who said we'd have a lost decade just raised their targets after stocks went up. Yet, so confusing that millions of people are making terrible money decisions based on headlines that change faster than the weather. Here's what really surprised me when I dug into what happened this year. The stock market gained over 10% despite countless scary warnings about crashes, recessions, and market meltdowns. Meanwhile, these same experts who spread fear are now admitting they were wrong and raising their predictions. But only after regular investors already missed the gains. But here's the part that'll shock you. Companies like Goldman Sachs went from predicting doom to raising their stock market targets by huge amounts, but only after the market already went up 25%. These aren't mistakes. This is exactly how the system works to keep regular people scared while insiders make money. Here's what Wall Street doesn't want you to figure out. The most dangerous thing you can do isn't picking the wrong investments, it's listening to these constantly changing predictions when history shows us something completely different. The big problems everyone faces. Problem number 1, the experts keep saying a recession is coming. Should I sell everything and hide in cash? This fear-based thinking is exactly what keeps people broke their whole lives. Simple answer, stop listening to recession predictions. The global economy is actually growing at 3% this year, which is way better than what these same experts predicted just a few months ago. Keep putting money in broad funds like VTI and ignore the noise. Better approach. Use their scary predictions as buying opportunities. History shows that when people invest at record high prices, they still make over 9% per year afterward. The best time to invest is when everyone else is scared. Smart strategy. Build your foundation with defensive investments like SCHD, which pays you over 3.5% every year while you wait. This fund focuses on companies that have been paying dividends for decades, so you get paid even when markets are crazy. Problem number 2, these predictions change every month. How can I trust anything these people say? This shows you the biggest secrets about how these big financial companies really work. The simple answer, stop following any predictions at all. The stock market hit new record highs this year, while experts predicted crashes. Just keep adding money to low-cost funds every month like clockwork. Better approach. When you see experts flip-flopping on their predictions, use that chaos to your advantage. While everyone else panics and makes emotional decisions, you stick to your plan and keep investing systematically. Build what I call an all-weather portfolio with equal amounts in 4 funds. VTI for growth, SCHD for dividends, BND for stability, and VEA for international exposure. This way you win no matter which expert prediction turns out right. Problem number 3, the market seems too expensive. Should I wait for a crash before buying? This market timing trap has destroyed more wealth than any crash ever could. Simple answer, stop trying to time the market. Experts think the market will stay in a range, which means regular investing at any point should work fine over time. The key is time in the market, not timing the market. Better approach? Large company stocks just had their second year in a row with strong gains, with the S&P 500 hitting 21 record closes this year. This shows continued momentum and strength, not bubble behavior that's about to pop. Smart strategy? Use scary headlines about overvaluation to add more defensive positions like SCHD while keeping growth exposure through funds like QQQ. Diversification always beats trying to guess what happens next. Problem number 4, international markets look dangerous with all the global problems. This creates the biggest opportunity that most people completely miss. The simple answer, start small with just 10% in international funds like VEA. Other country stocks have actually been doing better than US stocks this year, proving that diversification works. Better approach? Europe is showing real signs of economic improvement while the US deals with policy uncertainty. Smart money is quietly moving into international markets while everyone focuses on domestic fears. Smart strategy, split your money globally. 60% US through VTI and SCHD, 25% developed countries through VEA, and 15% emerging markets through VWO. This protects you from any single country's problems. Problem number 5, interest rates are higher now. Should I dump stocks for bonds? This reveals how financial media manipulates people through fear. The The simple answer: remember that stocks and bonds recently started moving in opposite directions again, which means bonds protect your portfolio when stocks fall. You need both, not one or the other. Better approach? Use a simple 70-30 split between stocks and bonds through VTI and BND. When one goes down, the other often goes up, which smooths out your returns over time. Smart strategy: keep your stock investments for long-term growth while using bonds for short-term stability. The experts expect continued strength in stocks over the long run, so don't let short-term rate fears scare you away from building wealth. The real facts that matter. Let me show you the actual numbers that destroy these scary prediction stories. Fact 1, the stock market gained over 10% this year despite experts predicting doom, proving that markets go up while experts spread fear to get attention. Fact number 2, companies lowered their stock market targets while the market kept hitting new record highs, showing they follow trends instead of predicting them. Fact number 3, global growth forecasts got raised to 3% from much lower predictions. Even the recession predictors had to admit they were completely wrong. Fact number 4, when people invested at record high prices in the past, they still made over 20% returns over 2 years. Record levels don't predict disaster. Fact number 5, this year's market gains came from different industries, not just technology, showing a healthier and most sustainable market than in previous years. Fact number 6, strong business fundamentals will help stocks keep growing, even if at a slower pace, supporting the case for continued long-term investing. Fact 7, analysts expect positive earnings growth despite all the scary headlines about economic problems and potential disasters. Fact number 8, SCHD pays over 3.5% annually with 12% dividend growth while focusing on companies that have paid dividends for decades, proving quality investing works regardless of predictions. Here's what makes these facts so powerful. While experts create fear with constantly changing predictions, the actual market performance keeps proving them wrong year after year. Your simple action plans. Plan 1, the ignore all experts portfolio, 40% VTI for total market exposure, 30% SCHD for quality dividends and defensive positioning, 20% BND for stability during volatility, and 10% VEA for international diversification. This gives you steady growth regardless of what any expert predicts and keeps your risk at a comfortable level. Plan number 2, the income while they argue strategy. 35% SCHD for defensive dividend quality from companies with decades of payments. 25% VYM for broader dividend exposure across over 500 holdings. 25% VTI to maintain growth participation, and 15% VXUS for international value positioning. This generates income while experts flip-flop on their predictions. Plan number 3, the all-weather method. 25% each in VTI, QQQ, SCHD, and BND with equal weighting that eliminates prediction bias. SCHD provides defensive positioning through healthcare, utilities, and consumer staples, while you rebalance quarterly to capture market rotations. You benefit regardless of which expert guess proves right. Plan number 4, the global opportunity approach. 50% U.S. stocks through VTI for broad exposure, 25% international developed markets through VEA for diversification, 15% for U.S. defensive positioning, and 10% emerging markets through VWO for growth potential. This captures worldwide opportunities while U.S. experts argue about domestic issues. Why you need to act now? Here's my bold prediction that will shock these constantly wrong experts. The biggest wealth builders over the next decade will be people who ignore predictions entirely and stick to systematic investing while others get scared out of the market. Why you need to start today while experts spread confusion. Reason 1, the market gained over 10% in 2025 despite countless scary predictions, proving consistent investing beats trying to time expert forecasts that always change. Reason number 2, individual stocks are still 10% below their highs despite index records, showing opportunities exist while headlines focus on overall market levels. Reason number 3, market strength is expected to continue into its third year, supporting continued systematic investing over trying to time perfect entry points. Reason number 4, different sectors like utilities and industrials hit new highs, proving opportunities exist beyond just the big technology stocks everyone talks about. Your step-by-step plan starting September 18th. Week 1, pick your strategy based on how much risk makes you comfortable. If expert predictions scare you, use Plan 1. If you want steady income while experts argue, use Plan 2. Week 2, start with your biggest allocation first, VTI for broad market exposure or SCHD for defensive positioning. Don't try to find the perfect moment to start. Week 3, add your defensive and international positions while setting up automatic dividend reinvestment to compound your returns regardless of prediction accuracy. Month 1, set up automatic monthly contributions and quarterly rebalancing. Let mathematics beat emotional expert forecasting that changes with the wind. Quarter 1, track your results versus the latest expert predictions and prepare to add more money when they inevitably change their forecasts again. The prediction circus never stops. Experts who called for crashes watch markets hit new highs. Companies cut targets while stocks keep climbing. Growth forecasts get revised upward after pessimistic calls. SCHD yields over 3.5%, while critics said dividend investing was dead. The question isn't whether expert predictions will be wrong again. They always are. The question is, will you build wealth through systematic investing while experts flip-flop, or will you let their changing stories keep you poor and scared on the sidelines? History proves that time in the market beats timing the market every single time. Your financial future depends on following this proven strategy, not the latest expert prediction that will change next month anyway. This information is for educational purposes only and not personalized investment advice. All investing involves risk of loss. Past performance doesn't guarantee future results. Consider consulting qualified financial professionals before making major investment decisions. Please like, share, and subscribe. Here's to your investing success. Profitable investing.